this topic that's been in the news for the past 60, 90 days is interest rates. What the heck's going on?
Absolutely.
Interest rates have been historically low, and people are a little bit fear based now on interest rates. It's been interesting, and it's changed the market for us a little bit. So. I think it's had a bigger impact than COVID almost.
One's, reacting. But one thing, what we're still finding, Tryf, and is that transactions are still happening at a record pace.
Oh, yeah.
And that's, barring any kind of major economic meltdown, I think generally speaking, we all feel that, commercial investment in real estate is going to continue to be very strong.
Yeah, and it's been interesting because rates topped in the sixes last month, which is unheard of. We haven't seen that in many, many years, mid 2000s really, and people are not really used to these interest rates going up, and it's a little bit of a different sell now. We still have a lack of supply, like you said, so the interest is there. There's a lot of capital waiting on the sidelines to be invested, and people still want to buy homes. But it does make an impact.
Yeah,
it really does. And
brokering a wide range of assets. Just in the past 30 days, we've been involved in single-family resident transactions, multifamily transactions, retail transactions, industrial asset transactions, and office transactions. And in just about all those scenarios, we had, there were great assets, and we had, multiple offer kind of scenarios. So, the supply and demand still were favoring the sellers, and those assets ended up trading at a pretty inflated level and quickly. So, I think right now that's still, a good indicator. And with these interest rates, the investors that ultimately have more cash, less leverage, really like it because it puts them in a position where they can win the bid.
Yeah, and I think the other misconception is every time you see in the news the Fed's going to raise their interest rates, everyone assumes that means mortgages or loans for real estate, and it really doesn't. And that's the big misconception we're seeing and educating a lot of people on it. It's not just mortgages. The reason rates are going up, obviously, is because our inflation is sky high right now.
Right.
We pumped $3 trillion into the economy in the past 18 months.
Right.
We've got to pay for it somehow, right? So costs have gone up.
Right.
There's a war right now, so they're saying gas prices are a result of the war as well. But really, with inflation, they've got to curb it. So the Fed's raising rates because they want us to stop doing consumer spending. What you typically see, though, is that the Fed rate is not just directly related to mortgages. Usually that's like a 10-year treasury that our mortgages are connected to. But what you're seeing is that, credit card rates are going up, home equity lines of credit are going up, auto loans are going up. Banks have numerous products that they give loans on, personal secured loans, things like that. But to the alternative too, like savings account interest rates are going up as well. They want people to park their money in the bank right now, and you're going to get a little bit better interest rate than you've been getting in the past few years because, again, they don't want you spending. So if you put money in a savings account, you're going to get a little bit better interest rate. So, it's not directly correlated to mortgages. And I think, Mike, one of the things we've been educating a lot of our investors in is I think on Wednesday they made the announcement they raised the Fed rate again another 3/4 points, and they just did that last month. But the interest rates really, if anything, they've actually gone down in the past 30 days.
Right.
It's an inverse relationship, and the mortgages, it's already baked in. They know that the Fed's going to raise the rates. It's going to be done one more time or two more times this year because, again, they're trying to curb the 9% inflation. So, a lot of people, and you see on the news, it's kind of fearful that, the Fed's raising rates and automatically everyone assumes rates are going to hit 10%. I don't think we're going to get there. We're going to find a new stabilization, but I think it's been good for the market too. It's kind of calmed things down a little bit as well from a velocity standpoint. It really has. And now it's kind of trying to bring the sellers a little bit back down to earth as well.
Yeah. And I think going back to investment, we've been underwriting, we've been underwriting the deals at probably 4 3/4, 5 up through 5.5 for probably the past 60 days. And, with ourselves.
Compared to 3.5 and 4, 6 months ago. Which is a big difference.
Ultimately, I think on the transactions that the buyers are looking at the lenders, whether if, typical, commercial transaction, $500,000 to, maybe 10 million, is where a lot of the deals that, the sweet spot is. I think ultimately still, the buyers are still in doing their underwrites. The lenders are still in. I think the only thing that we've seen really dramatically change is some of these, tens of $1 million projects where really, they're highly leveraged. There's additional loans to do construction. I think though, with the rates that exist today, those are the deals that sort of are getting a double take on, a hard look at. But the transactions that we've been underwriting at 5 are still, progressing as smoothly as the ones that have been underwritten, at 3.5%.
And I think we were ahead of the game because we were doing that before they kind of went up as well. So
Correct.
We were kind of prepping for it and
Correct.
figuring out how it would compress and all that. And the other thing too is that I think with the rates going up, it doesn't necessarily mean the deals change. Banks now requiring a little bit more money down. You've seen some of the 20% down loans go away because they need to cover their debt service, and some of the programs have gone away. So banks are also modifying the way they do lending, and you got to pay to play. If you want to buy the investment, you got to put some extra money down, and that's a little bit different than what was going on 10 years ago, where they weren't requiring any money down and still lending. So
no, absolutely,
the banks have gotten a little bit smarter.
Yeah, and even with the underwrites, most guys we're targeting, doing the 10-year underwrites, targeting 14-15% IRR. Again, bumping from 3.25, 3.5 to 5. Is not over a 10-year period in terms of a lot of those underwrites certainly have an element that top line is going to be growing. So still the IRRs are still coming in, favorable based on what their criteria is. And and again, going back to
that's investment, right? It's based not just based on today or yesterday. It's based on It's an investment. It's a hold. So
yep.
No one can predict what's going to happen in 5-10 years, but you've got to be conservative in your underwriting and try to think of every possible issue and solution.
Yes.
But again, an investment is not a one-day hold. So if rates go back down, and today they're at 5.5, and rates go back down in the 4s, you've got the option to refinance, cash out, get out of it. And it's going to make a difference on the investment as well. So it's an investment. That's why it's a long-term hold.
Yeah, and I know, Tryf, you've had this. We've had a couple of transactions. As we all know, a commercial transaction, multifamily, 60, 75 days, sometimes a little bit longer than that. But, the buyers have actually, recently in those 60 to 90 days have seen rates change, 150 basis points. But still, are proceeding with the transaction. So, Generally, we all hope for, interest rates to be at a level like they've been, certainly the past, 5 to 8 years. But ultimately, I think we're still, the investment market is.
There's always a market.
Yeah,
there's always a market.
There really is lucrative, and we're just going back to all those assets. We're just seeing such a demand for product right now that right now there's just not enough out there in terms of supply, and that's always going to at least create some upward pressure on that pricing. So sellers still are sitting in a pretty good position.